through a journey of the different stages of investing, and also talk about how all of you could become a part of the startup world if you're interested in investing in startups. So let's look at data for how investing has grown first, right, over the last few years. India has seen the most number of deals. We have seen almost $167 billion of funding in 2020 and my bad. India has seen 13 billion of deals in 2020 and going up to 35 billion. Whereas in markets like America, it's gone from 167 billion to 330 billion. So obviously venture funding has grown almost 3 to 4 times in India now. And this is capturing the deals which are only announced, right? There are thousands of deals which are done in the country which are never announced by startups or by the investors for various reasons. So let's look at some of what are the themes that investors are investing in historically, right? In 1998 to 2004, the themes were software services. So you had companies like Mastek and Kale. Then you came the dot-com era from 2004 to 2010, where marketplaces, internet, you had companies like Redbus, Naukri, Make My Trip, and all these companies raised a lot of money in that era. From 2010 to 2016, it was all about e-commerce and food. So you had Zomato, Swiggy, Flipkart, Snapdeal. A lot of companies raised capital that were following those sectors or that were building companies in those sectors. Then we had Wave 3, which is from 2016 to 2020. It's all about your online education. HR tech has become a big play. B2B SaaS, where organizations are offering their service to other enterprises. So these are kind of themes that investors. So generally, what happens with investors is they look at themes trending that year and then try to find the best company to back. This is just a small quote which had come out in the KPMG report. The number of unicorns that India has seen in the calendar 21 has been higher than the last 5 years put together. This, coupled with the fact that public markets have embraced Indian tech company IPOs, is just an indication of the fact that we are at the cusp of revolution in the Indian markets. 2022, in my view, is going to be a landmark year for the Indian startup industry and set new benchmarks. So as an advisor, we are also very happy that the stock markets are allowing companies that are making losses list on the stock exchange. And it's a sign that today, if you invest in a startup, there is a clear road to exit for investors. Earlier, this was not there. And I think with Zomato going public, the change is coming. Startup growth, startup financing cycles and growth stages. So let's look at the different phases of a startup and what kind of money can they raise, right? So the first phase of startup starts with basically the value of death. It's the time that they just thought of an idea. It's just an idea that time you're looking for some amount of money to build at least a minimum viable product so that you can build a startup, right? The moment you cross the valley of death, you hit the stage where you are, it's not break even in the sense of you're making break even in terms of numbers, but you've broken even at least in terms of idea, and there is some kind of product market fit happening, right? Then you have the early stages. Early stages can be various things, rounds 1 to 3, and then you have larger rounds, which are later stages, which either lead to IPOs or an acquisition or something else will happen. Right. On the right-hand side is a similar model that we have created, which is basically trying to reflect the different stages of your company, right? So seed, the value of death stage is basically where you don't even have a product. Series A is where you have evidence of repeatable, scalable, and profitable growth. This is Series A and Series B, and then after Series B is all about growth financing. So let's look at a couple of the different rounds that happen in a startup. So what's an angel round? An angel round is typically when you just have an idea, you want some money. So basically we call it the 3F round, which is the friends, families, and fools invest in this round because they're the only ones who will back you up at this stage. So basically the founders just have an idea. The pre-seed round is basically where the founders of a startup have developed a basic product at least. It's not 100% ready to go to market, but it proves the functionality of the product. And it also gives investors confidence that, yeah, these guys are capable of building something, right? So at this stage, they raise around $150,000 to $200,000, depending on the startup. Then you have the seed stage. This is where the companies have crossed the minimum viable product stage. They've got a product ready. They've got a few paying clients, but now they really want capital because they want to not take the product to market and get growth going and see traction. So earlier, seed rounds were $300,000 to $500,000. Now most of you read in the news, seed rounds are 2 million, 5 million, 10 million. So things have changed. But in general, those are offbeat cases. They don't happen very often. Typically, the seed rounds are around $500,000 to $1 million. Then you have a Series A round. Series A rounds and Series B rounds are where basically you've proved that there's a product market fit. You've got traction. You've got paying customers, and you've proven that the business model works. So basically, now you're raising money to increase distribution and to scale your business up. The series rounds A, B, C, D can keep going on depending on various startups. So there's the rehearsed we're doing a Series J round and things like that. Basically, typically after that stage, anything that happens for a startup after Series CD is basically leading towards an IPO or a merger with another firm in the same space. How could you invest in these kind of startups, right? So there are two options. One is direct investment. So direct investment is basically where you could invest into a startup either by identifying startups yourself and investing in them. Second way could be you become a part of these networks like Mumbai Angels, Chennai Angels, right? Where they give you a deal flow, you pay them a membership fee, you get deal flow from them. And then if you like the startup, you invest in them. And Mumbai Angels and all these organizations help you manage the paperwork and everything around the deal. You also have platforms like AngelList and Let's Venture. Again, you have people who are running deals on those platforms who are professionals. They basically become the lead investor for that round. And you can tag along with them because they've done their due diligence and you get a better access to deals. And lastly, from these platforms, everything comes at a cost, right? Nothing is free. So either you pay them a percentage of your success fee, not success fee, but if you make a good exit, they charge you a fee on the exit you make, or they charge you a fixed annual fee depending on the network that you are associated with or the platform you're associated with. The last way you can invest in startups is the indirect route, where there are a lot of funds who are always looking for capital to deploy. So you become a limited partner in those funds and you can invest in them. They charge you a management fee, which is 2% of the fund that you're committed to. And they also charge a carried interest. Basically, that's like a bonus, which is generally 20% of the returns you get. And always carried interest is always linked to the performance of it. So I hope I've given you some thoughts and clarity on how this world of startups.